Good morning.
Hi there. How you doing?
Yeah, I'm good, thank you.
Yeah, thanks for joining us today. So, as we usually do, we'll get you to do a sort of 5-minute intro on the fund. We've got some slides here. So, do you just want to sort of introduce what you're all about? We had you on last year, so
Sure.
people might be familiar, but
good morning, everyone. So, those who don't know the Regional REIT story, we are a real estate investment trust, obviously investing in high quality regional office assets in the major conurbations and towns throughout the UK. So regional, obviously in the title, regional by nature. We listed in November 2015 with the intention and commitment to pay as high a dividend as our income allows. I think we've clearly done that. Since coming to market, we have consistently paid one of the highest dividends in the sector and currently the highest in the real estate sector. You saw the slide a minute or so ago. Based on the most recent close, our dividend yield on declared dividends for 2022 now 12%, which is obviously very high compared to historic levels, and that on a 30% discount, as Richard pointed out. Let me just discuss our year-end figures first, and I'll talk more about the market in general. So earnings up 6.6 pence. We paid that fully in dividend this year, so 100% covered. And our coverage has been excellent since we came to market. NTA obviously down, purely down to valuation, on which a little bit more later, but valuations were hit very substantially at the end of 2022 and specifically Q4. In my view, not accurately or correctly, but nonetheless, we are where we are. I think the Blackstone story is quite interesting. I'll come on to that with Richard in a few seconds. Key initiatives for the year: continue recycling capital. So we do buy, create value, and then hold income in the longer term to pay dividends, or sell assets where profits can be realized and we can recycle into assets where returns can be higher. We continued our ESG progress, obviously a massive subject, one I don't want to cover fully today, but just to say we are fully committed to the ESG process, and we're making progress on that. Our EPC ratings are being driven forward year on year, and we have no issues whatsoever in meeting the timetables set out by the government. Not yet legislation, but will be, which is EPC B by 2030. And driving portfolio rental yields and controlling costs. Costs have probably been the biggest headwind. Obviously, we're in inflationary times. So whilst income has progressed well, costs have also increased, literally for every aspect of running a property portfolio. So that's been a headwind over the last year. Obviously, energy and utilities were a major part of that, which are beginning to come in slightly. So we expect to see some improvement on that aspect. But nonetheless, that is an issue for all property companies and all operators going forward. Like-for-like value decline, you'll see 12.1% versus MSCI rest of UK office at 17.3. So relative to the market, we've done okay, but I don't like relative performance. So 12.1 disappointing from our perspective. That, of course, doesn't include the capex of 10 million that we had last year. So that 10 million capex has not been added to the portfolio valuation. Debt and cash flow, LTV is up, as a result of the revaluation from 42.4 to 49.5. Our long-term target is 40%, and we're committed to that. And we will indeed get back to 40% over the medium term. Our debt is 100% fixed, swapped or capped, so we have no debt issues with a weighted average debt term of 3.5 years. 4.5 years. So we have really no issue, and the cost there, you'll see weighted average cost at 3.5%. So fixed debt, 3.5% for 4.5 years puts us in a strong position. Accounting returns you'll see there, and you can look at, compared to the market, again, relative performance. Compared to the market, we've actually performed very well. However, it is relative to the FTSE EPRA and REIT UK index. Richard, if you can move to the next slide, please, that'd be appreciated. So, what are we all about? Well, we're all about proactive asset management. One of our main differentiations is that we do everything in-house. So everything from investment management, property management, asset management, financial management, research, debt origination and servicing, all done within my business. So that does differentiate us from most of the operators out there. We had an extremely good year last year, 114 new lettings, 5.9 million per annum gross rental row value. What I can say in context, clearly 2020 and 2021 were COVID affected years. The year prior to that, 2019 being the last normalized year, just to put this in context, we had 73 new lettings accounting for 3.8 million of new income. So a record letting year in terms of regional REIT. We acquired 75 million, just recycling really of the 84 million of disposals. And interestingly, that you can see the arbitrage there on the disposals versus acquisitions. That obviously helps income and allows us to drive forward income and hopefully dividend. Occupancy up, which is pleasing. I'll talk a little bit more about the office market in a second. And then expiries, we continually renew over 70% of our leases. It was down slightly in 2020 and 2021 for obvious reasons. But if you look at the history since we came to market in 2015, it ranges between 70 and 75%. Next slide, please. So what are we all about? Well, we're all about de-risking. And how do we do that? Well, we do that through diversification. Now, clearly, we are office sector orientated, therefore not diversification in terms of sector, but diversification in terms of numbers of assets. You'll see 154 properties currently, numbers of tenants, 1,076, and a broad spread of those tenant businesses. So the pie chart or the donut on the right-hand side there shows the professions in which our tenants derive their income. So very, very important. This is done by standard industrial classification coding. Very important to us to understand where our income comes from, and that demonstrates a very, very broad spectrum of where our income's from. And really, the reason that we're so keen on looking at this is, certain economic trends and factors impact certain parts of the economy more than others. We need to try and understand where our income is derived, and therefore whether we can take action or understand where we might be impacted. And the broader spectrum of that accounts or allows us to account for the unknown. There's been very many unknown or unforeseen situations over the last 10 years, and we are just trying to create as robust an income stream as we can. Largest occupier represents only 2.4% of the rent roll. That's Virgin Media, and it's actually in 3 separate buildings, so no binary risk at all to individual tenants. Largest single property accounts for 3% of portfolio by value. Again, no binary risk in terms of individual assets. And if you look at that capital rate per square foot, £119 per square foot is just ridiculously low, in my opinion. The construction cost alone, excluding land, is now £240 to £280 a square foot. So it really doesn't make any real sense to us whatsoever that good quality income producing assets could have a capital rate of £120 or thereabouts. That just doesn't make any sense at all. Next slide, please. This is just an idea of the quality of tenants. I mean, people hear the word secondary talked about office assets and they assume they're poor quality and of poor quality tenants. That's simply not the case. They are secondary only by definition that they are probably 10 years or more old. and they are not in prime locations, such as, in Glasgow, it would be Bothwell Street, in Manchester, King Street, etc. So, they are in good, periphery locations or good secondary towns with high quality tenants. And this is a misnomer that we've been trying to get over since we came to market, whereby people assume poor quality buildings, poor quality tenants, and that's simply not the case. Next slide, please, Richard. EPC we were talking about earlier. This shows the movement, so quite a substantial movement now to B+. C, obviously there over a third, and D and E and below. E and below are assets that we are currently disposing of, so that will disappear over the course of the next year or so, being disposed for alternative use. And actually, if we just talk about that for a second, alternative, all of the assets we sold last year were for alternative use, bar none, from high quality business parks to city centre buildings, and those alternative uses tend to be beds or sheds, so residential, student accommodation, hotels, or industrial development. But that is quite an important aspect in the market when we talk about what is happening. Over 58 million square feet has disappeared from the office market since 2019. And I've been arguing, many of you have heard this story, I've been arguing really since 2015 that will be a driver going forward, in that a lot of buildings which are older and past their sell-by date in terms of the costs of refurbishing simply not being financially feasible will be repurposed. Now, if you put that in context, what we're now seeing is 3% of the entire market disappearing every year. Now, that's obviously not the prime end, that is the secondary end, and it's nearly all in the regions. So if you look at that in context, that is 7.25% of the regional market disappeared over the course of since 2019, and running at 3% per annum going forward. So, as I say, those E and below will be sold for alternative use. We've got a good track record in doing so. The rate per square foot that I was talking about earlier, £120, is very relevant because that makes it affordable for all of these alternative uses. We continue to drive GRESB ratings and the CapEx program. Let's just talk about EPCs and ESG in general. People believe there's a big black hole in all property companies' balance sheets because they haven't allowed for sufficient CapEx to take forward. Well, I've argued since this was introduced that this would be done in the normal manner of business plans. Every time we get space back, we refurbish to the best quality we can, not to meet government guidelines, but actually for good commercial reasons, because that's what tenants want. Tenants want good quality accommodation, and they're prepared to pay decent rents for it, and rents are increasing. So therefore, we're doing this as a matter of course anyway. We always have been. Our valuation, despite the fact it's down 12.1% to 789.5, that valuation allows for 60 million of CapEx. So the values have already baked that into our values. So there's no black hole whatsoever. So the valuation would have been 60 million higher had they not allowed for future CapEx, which of course will flow through to EPC ratings. Its governance, as you'd expect, given our PLC, is extremely strong for us. And social, this is becoming a much more important aspect. We're very strong on the employment element and improving always in terms of our buildings taking active roles in their communities, which is becoming far more important for occupiers. Understand that landlords and buildings are actually helping their local communities. Next slide, please. So this is probably most interesting for most of you, just our view on the office and what's happening. I talked about our lettings story a little bit earlier, and that is good. We're seeing continual demand and decreasing supply, despite the fact you have read this week 100 million square feet of empty offices. That includes offices where people haven't yet gone back. And if I can put that in context, the first part of my slide there, 99% of our tenants are now back. That was actually only 30% last March. And that 99% dates from the end of November 2022. So, we now have pretty much 100% of our tenants back in some form. And what we're now trying to assess and establish is how many people and for how long. And there's been a couple of studies done. Savills reported a European study undertaken a few weeks ago, showing that 70% was the pre-pandemic level, assuming that people are on holiday, some people be ill, some people be traveling. So if you had 100 people in the office, 70 would be sat at their desks at any moment in time. And they report that we're back to 80% of that number across Europe, i.e. 55% occupancy. So 80%, that ties in really well with ours. We're undertaking our own study just now. Obviously, I think we're a good bellwether of what is happening company-wise, particularly given our 1,050 or so occupiers. We hear from a lot of people, we have a lot of data. We're about halfway through, and halfway through that study is about 22,000 people. So it's a reasonable data point, and our data points exactly to what Savills have reported, 55% occupancy versus 70% pre-pandemic, but improving almost week on week, which is very encouraging for us as office landlords. Now, the other interesting point was, well, how long are they back for? People talk about hybrid working. I think we all expect hybrid in some form to be the way forward. Although my company are in 5 days a week, as are many others. But you've read only yesterday, some of the banks now insisting that their staff are in 5 days a week, particularly senior staff, which drives the junior staff in, of course. So, how many days back are they? Well, I thought our study would come back saying 3 at this stage. And I've been on record before suggesting that I thought it would take to the end of this year, end of 2023, before we see a new norm. And I think that's probably still the case. That new norm to me looks like being 4 and 1, 4 days in the office, 1 day from home. And that's actually what we're seeing on average of the 22,000 people studied so far. So that slightly surprised me. I thought it would come in 3 and 2 at this stage, and then ultimately end up at 4 and 1 by the end of the year. But so far our data is showing 4 and 1. And we will publish this data once it's complete. But as an interim position, that's quite encouraging. So supply contracting, demand remaining decent. There are challenges out there, undoubtedly. Energy pricing continues, inflation continues. We can obviously pass many of those costs on to our tenants, but we still sit with a high vacancy rate of roughly 17%, as you've seen on an EPRA basis. And therefore, we have to pick up the costs for that. So key for us clearly is reducing void. And we'll do that in 2 ways, or 3 ways, actually. One, we'll sell void where alternative uses are appropriate. We'll obviously let up more space. And we are introducing a flex space concept where we will offer all things to all people. If you wanted fully fitted out Cat A plus space, we will provide that for a cost. If you want an empty floor for a short period of time, we'll provide that again for a cost, or everything in between, from serviced offices right the way through. So that's another way of reducing our voids, given that many companies simply don't know what they need yet. Flexible space is at an all-time high, and we want to capitalize on that. Okay, next slide, please. Sorry, Richard, can we take that slide one back, please? So the top right-hand, very appropriate, I think, top right-hand quote there, Silicon Valley Bank, and we couldn't have written it better ourselves, but it was very appropriate. This was from their December 2022 financial reporting, and clearly, we face risks from prolonged work from home arrangement, and the answer was that even their board never met in person. Everything was remote. and they saw that as a high risk strategy for them as a bank. And clearly, this isn't the only reason, of course, that they went under, but nonetheless, they saw that as a risk. So I thought that was very telling, and I suspect why some of the major banks are insisting on 5 days a week working. Okay, Richard, sorry, next slide. So what are we seeing? Well, we genuinely believe there's no substitute for face-to-face collaboration. Of course, we're using technology this morning, but nonetheless, I think most people agree there is a place for technology, but face-to-face collaboration with colleagues is vitally important on a regular basis. Collaborative working, again, we believe that's better done in the office. Training, controls, and fun and interestingly, every cloud is a silver lining. Talk of recession, and indeed the costs of home living, energy costs, etc., are actually driving people back to the office as well. So we see a tailwind of return to the office. How will we make hybrid work? Well, I guess different companies will test different things and ultimately come up with a result for themselves over the course, in my view, over the course of this year. Given our tenants have only really been back since the end of last year, we think it'll take 12 months or so for them to decide what's right for them. The other thing, of course, is there will be then a lag because nobody likes double overheads. So companies will make do until such time as a lease event allows them to make a move, either upscaling, downscaling, or a relocation altogether. But that, I think, will bear itself out over the course of end of 2023 into 2024. Next slide, please. So for us, very much business as usual. We increased the annual dividend last year. We continue to be the highest paying REIT, actually just now, one of the highest paying REITs consistently. And we're committed to paying regular dividends to our shareholders. We pay quarterly, which I think most of you will be aware of. Also, you'll be aware we never cut or held back dividends over the COVID period. We were that confident in our rent collection, which was the highest in the sector right over the way through COVID, that we had no doubt that we were going to collect that money and pay dividends to our shareholders. Uplifts, yeah, we're also seeing rental increases, nothing like the rental increases that were pointed out in the industrials REIT, but 7.3% ahead of previous passing rents. But really key for us is to reduce that void. That is a huge potential win in terms of income for us. Recycling assets continues to be part of our strategy, and we continue to track a whole host of potential acquisitions. Okay.
Oh, great. Thanks, Stephen. Yeah, really sort of comprehensive and obviously a really topical and really interesting subject because the questions have been flooding in since you've been talking. So what is the time? 20 minutes to get through all of these. So we'll just crack straight on. Sure. The most important one, I suppose, is at the moment is valuations. Obviously, you've got your views on how they went for you in your most recent update. Let
me just touch on that if I can, Richard. So my view on value is not that we're at the wrong values, although I think we are. I think we just don't know. What should happen in a valuation cycle is, and obviously everybody accepts the fact interest rates went up, therefore that has to have an impact on values. But what should have happened and what's happened historically, and I've been working for 35 years now, so I've seen this a few times, is that interest rates go up. The investment market then takes some time to decide what it's prepared to pay for assets, given those higher interest rates, and then valuation follows when transactions occur. So they're following the market. Valuation should always follow the market. What happened this time was the valuers effectively predetermined in October, bizarrely, what the valuation decline was going to be. And they have effectively driven the market because, as we all know, most companies, including us, use an element of debt in acquiring assets. Therefore, that the banks will only lend against valuation. So it becomes a self-fulfilling prophecy. And to me, that was completely wrong. That's why we saw the highest fall ever in a quarter in terms of values, and the highest ever in a month in Q4 last year. And that, I mean, even much greater falls than we saw after global financial crisis.
Yeah.
And the only way to justify it is the value saying, oh well, we get criticized last time for not acting quickly enough. Well, yeah, but you can't. You've created a cratering of the market. And actually, I think the Blackstone story is very interesting. So Blackstone have taken a completely different view and said, we don't believe those values, and we paid effectively, and you'll see it when all the results come out, we paid last year's values.
Yeah, they did. Yeah. So where do you think over the next quarter? Well, we're at the end of March, coming up soon, and then the quarter after that, where do you think NAVs will go and values will go?
Well, Savills have put out some data last week suggesting that, and indeed, they produce these on a regular basis. They've suggested that the prime office market, and all markets effectively, but the prime office market is in between 1/4 and 0.5% over the course of the last, well, since December, so the last quarter. Now, that then filters through to my market, which is a secondary market. So I'm not going to predict values because the investment market will determine what it's prepared to pay, and there isn't enough transactional evidence just now to say, well, the market is valuing at this level. Clearly, the Blackstone story is a big story, but I think valuers are very quick to down value and very slow to up value. So we were valued on sentiment at the end of last year. Sentiment is getting stronger. Will that flow through to valuation? I don't believe so in the short term, i.e., our next value is June, and I'm expecting that to be flat. But I do expect to see an uptick by the end of the year.